Welcome to today's Tax Advantage Forum by Hardman Co in conjunction with GrowthInvest. I'm Brian Moretta. I am hosting today's session, also going to give you a little talk, and I have the wonderful job of keeping everybody running on time. But I'm really delighted that we've got today's our fourth forum, and probably the final one for this tax year. And we've got really four really interesting and quite exciting managers, I think, who are doing really interesting things in EIS. They're all doing things in a very different and distinct way. So they're all unique in their own way. And I think it's going to have a really interesting sort of session with lots of interesting ideas coming out here. The format is each manager will give a short presentation of about 10 minutes. There'll also be, hopefully we'll have time for a generic Q&A at the end. So if you've got something that's not specifically for a man, then you can pop that in and we will try and get everyone together and to answer those. So if you've got something for a specific manager, please try and do that during their presentation or as quickly as you can so that we can try and get to those at the end of each session. So now what I want to do is pass over to Steve Dobson, who is going to be handling Q&A, and he will introduce.
Thanks, Brian, and good afternoon all. Yeah, my name's Steve Dobson. I'm head of investment at GrowthInvest. And for anyone who doesn't know, GrowthInvest is a platform that operates in the tax efficient space, and we basically provide administration reporting services to wealth managers. Across the EIS we're going to talk about today, but IHT and VCTs, but also more broadly into private markets as well. I think Brian's given you enough instructions in terms of the Q&A. If there's something specific to a particular manager, please direct as such in the Q&A. And then likewise, if anything general, we'll save that till the end and we'll have more of a panel discussion on that. And Brian, back to you.
Thank you. Well, I'm going to start by giving a little introductory presentation. So I'm going to cover two topics today. I'm going to cover a little bit why you should be thinking about venture capital as part of your portfolio. And then I'm also going to talk about the tax release. So that saves everybody talking about them. And the tax release is a very important part of the presentation. So what's the case for investing in EIS? Well, the idea is that by investing in venture capital, you're investing in companies that are doing something that are just that bit different, or in some cases, a lot different from what quoted companies do. And that's not necessarily the activity, but it's the way that they're doing it. So typically, these are early stage companies. They are not established, so they don't have established revenues. And quite often, what the stage you're investing, they're creating a minimum viable product, they're finding product market fit, and maybe starting to scale. So if they've got product market fit, they'll be looking for new customers. So that's a very different profile from a company that might be more established, might be more dependent on what the economy is doing. For venture capital companies, actually, sometimes when the economy is doing badly, that's a good time for them to invest. So the activities they're doing usually perform in a different way from what you get for quoted companies. However, the quality of the exits depends on buyer. So eventually with the EIS company, the idea is you want to be able to sell the company or get an exit, and that's the way that you get your cash back. Mostly they're unquoted, so you don't have the chance to do that until then. The size of the exit depends on there being a nice buyer out there or someone who's feeling wealthy or a company. So if companies are feeling flush, they typically pay higher prices. If they're not so flush, they tend to be a bit meaner. So the venture capital has diversification benefits in your portfolio because it's doing these different things. It's not completely independent from market. So we reckon, based on the research that I've seen, correlation is about 0.5. This compares with bonds, which are about 0.3, 0.4, depending on the estimates you sort of look at. So that venture capital isn't as good a diversifier as bonds, but it's a lot better than, say, your typical private equity, which is around 0.8. So what that means is that if you use your asset allocation sensibly and holistically, you can add venture capital to your portfolio in a way without increasing risk, but increase the expected return. So you've got to adjust the other assets, and that can give you a nice sort of uplift to your expected return in your portfolio. So I did a paper on this about 3 or 4 years ago. And what we suggested for the average investor, you probably want something in the low teens in venture capital. That would be about the right risk profile. Obviously, it depends on your circumstances, and you probably want to speak to an advisor if you want to apply this rigorously. That's the investment case. However, I think it's very important to sort of, one of the reasons, or most attractive reasons, are the tax release. I'm not going to go through these in great detail. If you really want to look at these more, I would thoroughly recommend we did an EIS basic series last year for the EIS Navigator podcast. So you can find those on YouTube. You can find those, the audio on a website, and those run through in more detail. But I'll give a quick summary just now. So in EIS, you can get 30% of income tax relief. That means that if you invest £10,000 into EIS, then assuming you have available relief, you can get £3,000 of that tax offset against that. So your net investment will only be £7,000. And there's also carrybacks, so you can apply it in the current tax year, or you can take it into the preceding tax year if you want to shuffle that around a bit. You got capital gains tax freedom, which means no capital gains tax payable on any gains. So if you make a lot of money, no capital gains tax, which I think everyone appreciates. Capital gains tax referral relief is on the way in. So if you have a capital gain on an existing investment, you can then invest that in EIS and defer paying that CGT until the investment is realized. So that can allow you to gain investment returns on the capital, on the money that you would actually have paid on CGT. So that can be valuable for people who've got that. Loss relief protects the downside. So that means that if a company fails, or if you've got a advisory portfolio, when some of your companies fail, you can offset that net loss against income tax. So the net loss would be, if you get nothing back, that would be 70p on the pound, because the income tax relief is discounted. Loss relief can be a very valuable, I think, an underestimated part of the portfolio, because if you've got a portfolio of EIS companies, then you would expect that some are going to fail. So at some point, you're going to be able to claim loss relief. And I reckon it can add maybe 2 or 3% to your IRR on a portfolio. And the final thing is inheritance tax relief. EIS shares generally are unquoted or they're on AIM, which means they qualify for business relief, which means they can be exempt in your so that it wouldn't be eligible for business relief. That has been, as what does the budget know, that has changed. I'll just talk about in a minute. I'll mention SEIS. A couple of the managers today do have SEIS as part of their options. Very similar. CGT release a little bit different. Income tax relief, you get 50% relief rather than 30. So, but these are very, very definitely earlier stage companies, even riskier, often pre-seed, often got no revenue. So definitely you get high tax relief, but at high risk. I wanted to add something about the budget. Everyone will be aware that the budget was tinkering around with things. Increased investment limits, which I think matter from a holistic perspective. The reality is, for most EIS funds, they're not going to make a huge amount of difference. So most funds invest what's called seed to Series A, which is kind of very early stage. And there's usually later stages beyond that EIS funds can't participate in. This will probably allow a later stage, but not by very much. And I think a lot of EIS funds probably are not raising enough money for this to make a meaningful difference to them. So it might get their pro rata in a later stage. So it is helpful. I don't think it's going to be a sea change for EIS. VCTs are a bit different, I think. So come back to business relief. I mentioned about the cap. So in the 24 budget, the government proposed capping the amount of capital that could be eligible for business relief at £1 million in any state. They have realized that's too small. And last year, they announced they're going to raise that. That's actually going to be 2.5 million. And that is actually going to apply from the start of the next tax year. So essentially, if you have EIS assets up to 2.5 million or other eligible business relief assets, they will be exempt from the state for entire tax purposes. Anything above that, you get half relief, which means that if you're paying 40%, you'll get 20% relief on that. Although it's not necessarily relevant today, I think worth mentioning VCT income tax relief is also going to be reduced as of the next tax year to 20%. And I think one of the observations I've made to a few people is that EIS in the last couple of years, in some senses, the tax reliefs have been kept fairly static. Everything else, it feels, has been made less attractive. So I think that's going to make EIS a much more attractive option for people going forwards. So that's all I wanted to say. So I'm going to stop there. So I'm going to start, and we're going to introduce our first presenter. And today we're going to go in reverse alphabetical order. So we're going to start with Octopus Technology. And I'm delighted to introduce Andrea Micah, and Lucius Carey, I think, is going to contribute as well. And they are going to talk about the exciting science-based investments that they do. So over to
Thank you very much, Brian. Here we go. So Oxford Technology was founded in 1983, and we've been making science and technology investments since 1983. Over 200 investments to date. And in 2012, the SEIS scheme was introduced, and we realized it was absolutely perfect for what we do, which is backing early stage science and technology companies, of which we see many. We see around 1,000 things that might be investable, probably 200 more reasonably investable for us. We'll look closely at about 60 and then make an investment in 6. That's a year. That's what we've been doing the last 10 years or so, and it's been going rather well. An example of things that we've invested in the past, Organox was in the news a little while ago for its 1.5 billion cash exit to Terumo of Japan. It's a machine that allows livers to be looked after awaiting a transplant, and this means that surgery can happen at a sensible time of day. The surgeon can be certain the liver is in optimal condition before it's transplanted. It started off with academics who had an idea of how they wanted to do it, and we backed them. And that's as early as we go in, right at the start. We have 2 funds. One is the OT SEIS fund, where we invest money over a 3-year period. Doesn't mean you get it back after 3 years. It means we split it, and then the first chunk in the first year is invested under SEIS, so with the increased tax break mentioned before, and we then follow on in the companies that desire and deserve more funding with typically with EIS, although sometimes now the second round of investment is also SEIS. And the aim is to maximize the long-term returns, not the tax break or the timing of the tax breaks. And you'll see that those long-term returns are worth waiting for. The second fund we have is an approved fund, which means that it can be the tax break is backdated to the date that the fund starts. So we have one of those every quarter. They're EIS only, so they don't have the SEIS tax break. We invest in 5 companies from our portfolio that we are at an advanced stage, usually selling or getting very close to commercialization. The next round will be opening in March. We're just waiting for the HMRC's approval, and will close just before the end of the tax year so that the tax relief can be claimed in this tax year, or in fact even in the preceding tax year should that be necessary. So anyone who's left it a bit late, very good. So here we're backing companies that have a shorter time to exit compared to the SEIS companies. The tax reliefs have been covered, so I won't go into those again at this point, but they're very generous and they allow us to take the high upside risks that we do. This is a full view of our portfolio. We're not going to go through it all now. You'll be relieved to hear. But if you go onto our website, you can download our quarterly report. It has the full portfolio. It has a full history of every investment we've made, including all the ones that have failed, and of which there are about 10% or so, 10, 12% of the things have failed. On the right, you can see the way in which the returns come. There's a portion, the green portion is the tax relief, red is cash back, and then the yellow and orange are cash due and fair value of milestones. Sometimes when we sell a company, there's still money coming in over a period of time, potential further milestones, which we would need a taller screen to get it in because one of our investment has very high potential further milestones. Just to give you a sense of the companies we invest in, Refine was a spin out from Oxford who developed a device which was over 1 billion times more sensitive than the next best device, and that allowed them to enter the market quickly and grow. Their share price went from 63p when we invested to £5 a share now. There was a big investment from a US VC, and they're looking to make their return on the upside from £5. So we think this might end up in a very good position for us. More recent investment is Metacarpal. They developed very lightweight and flexible prosthetic hand. People who've used robotic hands say this makes a world of difference because of the responsiveness and the ease of use, and because it's light and they don't have to lug a heavy thing around the whole time. That started to make very good sales in the US. We invested just well, I guess it's almost 2 years ago now. Time flies, but we expect that share price to go up once the sales kick in really well. And a third example, this is what kind of technology I love. It could have been done 30 or 40 years ago, but no one spotted the opportunity. The founder of this company understood that people who've had accidents or trauma, such as on a battlefield, tend to get hypothermia. And also when they have to be moved off their stretchers to have x-rays to find out what's broken. And you can understand that's a really bad idea. So they've developed a stretcher which is x-ray transparent and provides built-in warming. So patient is comfortable, well, as comfortable as they could be, to all the way to the hospital, into the x-ray machine, and then they can be moved once they know exactly what's wrong. And these are the kind of things that there isn't such a device, and the interest from the US military in particular is great. Another reason we like this company is that we knew that it didn't have to go through medical approvals in the US. There's an exemption which allows stretchers to be put straight through, and that really speeds up. And over time, you learn what it is that can hold companies up. To give you an idea of what a portfolio might look like for an investor, if you advise someone or if they choose to take it up. In 2014, I invested £15,000 into the fund. It ended up being invested over 10 companies, the first 6, and then there were SEIS, and then there was some money left over at the end. So that went into a couple other SEIS investments, and a few of the companies are doing very well. One has done very well and has exited, and I'll tell you a little more about that next. So Ducentis they developed a new kind of drug. We spotted them at a presentation. It was an Innovate presentation, and we were the only investors in the room who decided to speak to Ducentis. We found their approach, even though they had no data yet, it was very clear that their idea was sound. We gave them the first money to do the first experiments to show that what they were planning on doing would work, and it did. We gave them another 50 after that, which allowed them to get to the point where other investors then joined in. We'd invested at a share price of 14 to begin with, and others invested then at 36p. And after a while, they were bought out. And as you can see, my investment from the £15,000, £4,000 went into Ducentis. That's already provided a £49,000 cash return to date. We're expecting in Q1 of this year over another £14,000 to come in. And if everything is successful, as we hope it will be, there will be up to $500,000 in milestones and royalties going forward. So the return from that is very attractive. And it's been a strong driver for people in various years of the portfolio. But as you can see, over the years, this is people who've invested in portfolios in different years. The X, as I'm indicating here, is how much they've invested, and this is what their portfolio is worth now. The newer companies haven't had time really to grow in value yet, but that will come because some of those companies are starting to do very nicely. Just a quick reminder of the two opportunities. We have the SEIS fund, investment spread over 3 years. Although we take all the money up front, we invest over a 3-year period. The track record shows it works. It's high risk. It is very long term and illiquid, but as a part of a portfolio, it can mean that you end up with a good return over the longer term. And the other one is the OTKI fund, where we invest rapidly. The tax break comes in right at the front. We invest you get the tax break on the entirety of the investment, whereas the SEIS, the fees don't get the EIS tax relief. And the next one of these will open in March and close at the end of the tax year. That's what I have to say. Thank you very much.
Andrea, thank you for that. Very, very, very informative. Got a couple of questions that have come in. Obviously, with the VCT, you're invested into a more established portfolio. You've talked about some of the historic investments you made in the EIS. Anyone going in now? Have you got some insight into what they could be going into?
Well, if someone were to join the OTKI fund, they would be going into a company that makes use of AI to improve MRI diagnosis of prostate cancer. They have already got good sales, over 2 million, a contract for over 2 million from the NHS, and they will be going into a company that has a technology which increases the growth rate of plants by about 10 to 15%, which is a massive improvement in the margin for agriculture, and also a company that helps detect risk of falls for patients in the US. And if under SEIS, one of the investments would be, and I'm very excited about this, a battery technology which fits in perfectly with all existing battery technology, but provides a 30% uplift in performance. And we think that's going to really move the dial UK.
Excellent. And then I guess one thing in EIS space, again, it's difficult to see performance and do relative performance against other funds. How does Oxford Technologies stack against the other EIS, SEIS fund managers?
Well, it's difficult to tell because they tend not to be quite as transparent as to what's going on. We're very transparent and we know the results. The returns, as you've seen, are good and promising for those who are there. And we have quite a number of investors who say, yeah, we've decided to come with you because we can see what you're doing and we really like it. It's clear for us to see. We can see how it works. We can see it takes time, but we can see it provides good returns.
Excellent. And then last one I've got, obviously you've mentioned there you've got the combined SEIS and EIS fund and the knowledge intensive fund. Do you see a different type of investor going into the two different funds?
Yes. When people have left it a bit late, they will go into the OTKI fund. And if they're long-term planners, they go into the OTSEIS fund. But both of them are.
I should say that lots of people go into both of them.
Yes, quite.
Interesting. Excellent. Okay, that's all the questions I've got. So, Brian, have you got anything?
No, I think we'll move on. Big thanks to Andrea and Lucius. I've known both of these people for a long time, and it's quite interesting to speak to someone who has been invested in this industry for such a long time. I think that gives a very interesting perspective on what goes on. So I always enjoy chatting with Andrea and Lucius. And if you ever want to find out more, we've interviewed both of them on the EIS Navigator podcast, so you can go and find those episodes where they talk about what they're doing.
Right. Thank you.
So we'll just let this poll hold up for another few seconds before I introduce our next guest. So I think we shall move on. We're going almost from one extreme to the other. So if we're going from possibly one of the longest standing EIS managers to a much newer manager in OnePlanetCapital, who focus on environmental and impact investments. And I'd like to welcome Declan, who's going to tell you all about it. And hopefully he's going to tell me what that mountain is on the first page as well, because I'm really curious.
Thanks, Brian. Yeah, so like Brian said, my name's Declan Kevely, co-founder at OnePlanetCapital. We are a specialist EIS investment manager and a slightly newer proverbial kid on the block. We've been going about 5-6 years now. Like I said a moment ago, and Brian's alluded to, we are a specialist manager. What we do, everything that all the businesses we invest into, all of the funds, all of the strategy, all of the due diligence is focused through our lens surrounding our investment thesis, which is all around combating climate change. So our investment thesis is that we're investing into early stage businesses and technology that are tackling the world's largest environmental issues. So we're really honing into that climate technology sector. Now, we're doing that really, I would boil it down to two core reasons. The first is that we do generate a positive environmental impact via our investments. We do have the FCA Sustainability Impact label. Now, naturally, that appeals to a lot of investors that are more ESG leaning or more impact leaning, and we can demonstrate that. And I think it's quite difficult to get the sort of impact that we are achieving in your wider listed portfolios, being sort of boots on the ground, as it were, and your clients' money really supporting new technology that is driving changes in climate impact is really important for some investors. That's the first reason. I would argue not the main reason that we're in this sector. I would say unashamedly that I'm a capitalist and I'm here to make money for myself, for you, and for ultimately our clients. We just so happen to believe that actually businesses and technology that makes things more efficient, reduce carbon, reduce fuel usage, reduce electricity, have the ability to generate large returns for clients as well. So in early stage impact investment, I truly believe, although take with a pinch of salt, that you can have your cake and eat it at the same time in terms of getting impact, but as well actually generating returns for your clients as well. So that's what we're doing. So today really is just to try and shed some light on why we're in this space, to try and get people excited about sort of early stage climate tech investing and give you a flavour of who OnePlanetCapital are. So I've kind of mentioned this up front, but we think this sector of climate technology is really exciting from an investment perspective. The main reason is because we are on a transition to a green economy. This is happening. Regardless of sort of what political power is sort of leaning in the US, we are making an impact on our carbon reduction. Last year, the EU produced 8% less carbon emissions than it did the year prior. So we are making change here. This is happening. Now, whether you are ESG leaning or not, what we want to invest into are businesses that make things more efficient. It just so happens that that efficiency is a reduction in carbon, reduction in fuel, reduction in electricity. That is just good business sense. That's why we really like this sector. We think there are sort of four core main drivers as to why this space has got legs. Firstly, is that most people now recognise that there is some form of climate emergency. That's relatively widely understood, and people are generally happy and on board with that. The second thing is that we're starting to see governments legislate towards net zero, and we're starting to see that at an increased rate. And really interesting in the last few years is the way in which we're legislating is changing. So for a long, long time, particularly in this country, we've had a target objective of being net neutral by 2050. I personally don't think that that target objective has driven a huge amount of change. It's been a very nice thing to talk about and a very nice thing to sort of target towards. However, a small to medium-sized business owner, the last thing on their mind is what the objective is in sort of 20, 30 years' time. But what we have seen is that change. So we've come down from a government pledge or government target objective to when we're starting to see much, much more sector-specific regulation, and that is driving change. So, of course, we're probably all aware of this. We've got the ban of the sale of petrol diesel cars coming over the hill in this country by 2035. There's a piece of regulation in the retail space called the Enhanced Producers Responsibilities Act, which is all around large-scale consumers and the amount of plastic packaging they use. So corporates are starting to look at their plastic packaging supply chain and seek solutions, because otherwise they're going to be hit with big tax bills. Like I said, the electric vehicle changes coming over the hill, that's changing the transport sector. So there's lots and lots of change that's being driven by regulation. Now that creates an opportunity for new stage technology. New technology will be able to capitalize on these changes from these massive, massive markets. And we're starting to see that. And that's the third pillar here. The corporate behavior is changing, and corporates are desperately seeking solutions to either become more efficient, either to adhere with what their consumers want, or to adhere to these new regulations that are coming over the hill. And that's the fourth part there, is that consumers are starting to take the stance. And as long as they're price parity, I think a few years back when there was a bit more money floating around, sort of 2020, and there wasn't a cost of living crisis and interest rates weren't so high, people were willing to spend more to support sustainable causes. That's not the case now. So as long as there's price parity, people are willing to support more sustainable and climate conscious businesses. So all of that is to say is that there's a really strong investment thesis behind climate technology. If you can, take one thing away from this presentation, is that I think early stage climate investing does not just have to be for ESG clients. I think that this, as part of a wider portfolio, has its place, and there are some really exciting businesses and technologies here. So that sets the scene. So where do we actually invest? Climate technology is a very broad church now. It's been developing for a long, long time. And in the last few years, because of those different factors that I've mentioned, we're now starting to see some really exciting different sectors and different industries that encompass climate technology. And that's what we look to do for clients. So we deploy clients into a portfolio of climate technology businesses, all with similar characteristics, but spread across our core subsectors. And these are the sectors on the screen here. So energy markets, that's probably what people most likely think when they think climate change and climate technology. Clearly, under the EIS rules, you can't invest into businesses that produce energy anymore, but you can invest into businesses that improve the efficiency of those businesses, and they improve the output of these renewable energy technologies. And we're seeing some really fantastic growth in that sector. Transport, mobility, and the logistics surrounding that is a very, very large, well-known sector within climate change. The automotive sector is very, very well developed. It's not personally something that we get involved in. A lot of these businesses are very, very large, very well developed. However, we're seeing some really interesting change in other methodologies of transport. So marine technology, for instance, is something that we're seeing fantastic growth in. And the UK, as an island nation, no surprisingly, produces some really, really fantastic marine-based technology. And there's some really great businesses there. And I'll talk about one of them in a moment. Buildings and construction being the next subsector. So this is all around new materials, new methodologies of coming up with construction materials, but making them cheaper, more efficient, and using ultimately less carbon. There's a lot of regulation capturing that subsector. Final core subsector being packaging, waste, and recycling. So this is all about reducing packaging, reducing wastage, and increasing recycling. Again, a lot of regulation in that subsector. And then the final subsector that we talk about, which is a bit broad, is wider technology. So this encapsulates a lot of software and SaaS businesses and some AI businesses as well. Again, one thing to take away is that climate technology isn't what it used to be. I think if you ask most people to think of a climate investment, certainly 5-10 years ago, I imagine most people would have set up a solar farm. Now, there still is a bit of that, but there's some really exciting technology across the board here. It's not just energy, and we can build a really nice, well-diversified portfolio of different industries, different subsectors, different business models, but all with those same interesting and exciting investment thesis characteristics within their portfolio. Just a very quick one on sort of the businesses that we like to meet and how we think about our investment due diligence. Most managers will have a similar process, but just to shed some light. So we focus our investment due diligence around what we call 6 core pillars. This encompasses the team, the market, the product or the USP, making sure that that company has a clear momentum of growth and that they have a trajectory to hit revenue targets, that they have a positive environmental impact. And for the EIS fund, it's very important for us and it's a requirement for us that they are able to give us clear, measurable KPIs on how they provide that positive environmental impact. We tend to see businesses fall into one of 3 buckets when we're talking about impact. The first being a direct removal of carbon. That's incredibly difficult. That's kind of scope 1. That's your gold standard. But that's very, very difficult for businesses to actually remove carbon. The second bucket or second scope that businesses fall into is the displacement of carbon. And this is where most businesses fall into. These are businesses that through their natural trading activities, because they are a cleaner, cheaper, more efficient way of doing things, the alternative would produce more carbon, but because this is being used, it displaces that carbon being used. And then the third scope that we talk to is an improvement towards a more sustainable aesthetic. And these are businesses that are helping the transition. So they're a little bit more intangible. Most businesses in the portfolio fall into that scope 1. So most of the time we're thinking about displacement. And again, I'll paint that in a picture when I talk about some examples. And then the final thing, which is important for all managers, is making sure that they have a viable business model and a viable financial model. So we do have 2 funds, but I'm talking about one today predominantly, our EIS fund. We also do have an SEIS fund. So with the EIS fund, clients receive 6 to 8 climate technology businesses in each tranche. Again, similar characteristics, but spread across those core climate subsectors that I mentioned previously. We have a £10,000 minimum ticket size. The stage of investment is what we refer to as pre-Series A and Series A. So everything in the EIS portfolio has revenue at point of stage of investment. We're certainly out of the kind of a crazy idea in a shed. These are real tangible businesses at this point of which that we want to get involved and invest with them, which is really important. And then I suppose the last important thing is that we are tranche based, but because we are a little bit smaller than some of the other managers here, we do get money out the door very, very quickly. So there's a lot of really fantastic businesses in the UK in the climate technology space. There's some fantastic opportunity out there. And because of that, we were able to get clients deployed really quickly. So if anyone is considering investment this tax year, we're currently raising for our deadline of the 25th of March. At that point in time, we'll close fundraising and we will aim to get clients fully deployed this tax year. So we are good at getting money out the door and getting money invested. So just the last couple of things from me, I just want to give an example of a couple of businesses that we invest into to bring it to life a little bit. So this is a business in the portfolio called GT Wings, or what was known as GT Green Technology. These guys are trying to improve the efficiency in the cargo and shipping sector. So as you can all imagine, these great big cargo ships, massively pollutant, using huge amounts of diesel. Their issue is that they are not as efficient as they would like to be from the ship owner's point of view. So where GT Wings come in is that they have developed a bespoke wind propulsion unit for these cargo ships. You can see it on the front of the ship here. So these things are retrofits. They can be installed into pre-existing ships, and they generate thrust, they generate wind propulsion on each ship. They save ship owners fuel. That's why ship owners like this technology. They've been proven on sea trials to save up to 25% of a ship's fuel usage in diesel costs. So there's a real business case for Shell, Harrisbrook Shipping, to actually install these units, regardless of whether you think these businesses are green or ESG or not. They certainly want to reduce the amount of fuel that they're using. So that's a really exciting business in our portfolio that's performing really well in the transport space. Another very quick example in a completely different subsector is a business called Kelpie. They are a bioplastic business. So what they're trying to do and what they are doing is developing a new plastic-like material from organic matter, in this case, seaweed and kelp. So it's a fantastic material, and they're really plugging into the food and beverage market. And like I said up top, there's more regulation coming into that space. So a lot of supermarkets and food and beverage manufacturers, they are seeking new ways of developing packaging, and Kelpie is a really fantastic solution for that. And the last business that I'll speak to, again, completely different business, completely different subsector, business called EREX. These guys are in the built environment or construction business, and what they are trying to do and what they are doing is solving the energy efficiency that the UK and European homes have. So UK homes have got incredibly poor ventilation. Now, we all know this in the UK, problems with damp, problems with mold, energy loss due to poor ventilation. Most ways in which Victorian or older style homes in the UK are ventilated is what's referred to as just a dung ventilation system, which is just a brick with some holes punched in it to allow for ventilation. And this causes all load of problems with damp, mold, etc., etc. So what EREX has developed is the world's first smart air brick, retrofit brick, which can be installed into a pre-existing ventilation system. And what the rub is here, why this business is exciting, is that it's got adaptive ventilation systems that's adaptively open and closed based on a whole host of different conditions, such as damp, mold, temperature, and ultimately it's been proven to save up to 12% of the UK qualifying home's energy bill. So again, it boils back to this: is there a real cost incentive for these businesses to exist? And a lot of times there is, and that's exactly what we like to see, coupled with, does it improve? Does it reduce electricity usage? Does it reduce fuel usage? And does it combat the changing environment that we're seeing? So look, that's my quick summary. Just to cap it off, we are a specialist manager focusing on climate change and climate technology. I do think that there's inherent diversification within this space, and I don't think this is just for ESG clients, although that naturally appeals to some of them. That's me.
Declan, thank you very much for that. Some super exciting things going on in that space. Some of these questions I think you've covered off already, but I think it's definitely worth going over some of these. Going on to some of those examples you showed, what particular areas excite you most from an investment perspective in terms of heading towards the battle to combat climate change?
Yeah, it's a really good question. So a really new exciting subsector that we're seeing sort of verge over the hill at the moment is called climate adaptation. So there's a whole host of businesses and technologies that are effectively saying, right, the planet is warming and there are going to be consequences of that. There's flood risk, there's all sorts of things. And this causes issues for everyone. But most of all, for businesses that are multinational. So there are businesses that are now developing to say, right, how do we actually prevent, adapt, and actually, come up with solutions for this crisis? So preventing and helping adapt rather than just reducing emissions. And there's some really, really interesting businesses in that space.
Excellent. Questions come in. Do you exclude fossil fuel companies?
We do, yeah. So we have a strict mandate that everything has to have a positive environmental impact. If a business, so it would naturally be excluded if it was fossil fuels.
Perfect. You mentioned earlier about the political climate.
Yeah.
Mr. Trump, has he made the climate change agenda a more difficult sell?
Yeah, it's yes, in a word. Not to beat around the bush, he has. I think there's definitely been a reneging. What I've actually seen is a slight pendulum shift, I would say, away from broad ESG, based not just on Trump, but I think a whole host of different things. My kind of rebuttal to that is that we're not ESG. We are trying to and do invest into tangible businesses that solve a business case. I would argue to anyone that's a climate denier or doesn't give a flying monkeys about the climate, that businesses that like GT Wings that they save emissions, they save costs. That's just a robust business case. It just so happens that it's reducing carbon. But look, demand certainly has sort of fallen particularly in the retail space. And I think, that's mainly captured around ESG, the ESG issue. I mean, if you look at institutional fundraising in UK and Europe, climate technology is a bulwark. It's a really, really massive sector within institutional venture capital markets, but it doesn't often get replicated in the retail space.
Perfect. Thank you for that. I see Brian's appeared again, so I guess time's up. I'll hand back over. Thank you.
Thank you very much, Declan. I'm sure the poll there is. I was just waiting for that poll to appear. We'll give you a few seconds like that. Listeners of the podcast know I'm a big fan of sort of environmental, of people who are trying to solve things in the environment. So it's good to sort of see OnePlanetCapital sort of finding some traction and keeping the flag flying in what, as it, people said, been a challenging environment, I think, in some ways.
Indeed.
So
Cool. Thanks, everybody.
So we'll give that poll a couple more seconds, and then we'll move on to our next guest, who is, let's wait for that poll to go. So our next guest is Olivia Drum, who is with Haatch. Haatch are another specialist manager who focus on B2B SaaS and have done very well over the last few years. So I'm going to hand over to Olivia, who's going to tell you all about them.
Hi, everybody. Thank you so much, Brian. Thank you to Hardman Co and GrowthInvest for having us today. It's good to see a few familiar faces, but if you don't know me, I'm Olivia Drinnan and I'm responsible for advisor fundraising at Haatch. If you don't know Haatch, we're a sole EIS and SEIS fund manager, so hopefully right on the money with the topic today. Quick risk warnings, which I'll skip through because we all know it's high risk and not going to be familiar for not going to be appropriate for all clients. To tell you a bit about Haatch, I think it's best to start right at the beginning and kind of how we hatched, or how we were founded by the two founders on the screen. We were founded in 2013, so it's Scott on the left and Fred on the right. And it was really founded because they are themselves repeat entrepreneurs. So they're business angels. It was really driven by their own frustrations as entrepreneurs, raising capital by investors, but maybe not having their own entrepreneurial backgrounds and ability to help them scale and exit. So they actually have worked together in two previous businesses, actively combined over £100 million worth of exit. So Kiddie Care, some of you might remember that company. It was actually sold to Morrison's Supermarket for 70 million. It was a tech-based pushchair business. It's kind of like a bit of a competitor. I think it's Mother Care that we have at the moment. Haatch is really all about how our founders have really kind of grown together. It really does help that they're super close to the industry. So Scott is now a board member of the King's Trust, which it is now. He received his own funding for them when he started in Kiddie Care, which is a really nice round circle moment. He's awarded an OBE in 2022 for services to tech and retail e-commerce entrepreneurship. And Fred on the right is a board member of our industry body there. So both really connected to the industry. Now, our design team has gone a bit wild with this slide, so I'm not going to go through every single stat that we can see. But the key message with Haatch is that we are in an incredible rapid growth and scale stage. So if I was speaking to you this time last year, I would have been saying that we have raised about 50 to 60 million pounds, whereas we're now over the 100 million raised mark. That's just how we calculate our AUM. I'm literally having to update this slide weekly as our investor numbers are soaring. The portfolio value figure in particular, that keeps on going up. We're on about 1 billion now. So I think if you've not come across Haatch before, now is really the time to meet us. We're really becoming a key industry player, and one that your clients will be familiar with and hopefully bringing up. And I think the reason to that boost is because of three key things. So Brian kind of just alluded to this. We've had a lot of recent successful exits. So we actually had 5 just in 2025, last year alone, all of those profitable, all of those returning funds already to investors. I'll talk to you a bit about some examples of those in a minute, but really high returns and past the 3-year mark, which is really important. The other thing that I think clients really like about Haatch is that we're fully backed by a government-owned bank. So that works really nicely with these schemes, obviously being government schemes. So we're backed by the British Business Bank. If you speak to Scott, he will tell you that the amount of due diligence that we had to go through to receive this funding was mental. It was more than anything that he had to go through selling kiddie care to Morrison's, literally 3 years of intensive research into our investment thesis and then some. But we were awarded this, and it keeps on going up. We're on £27 million. From your perspective, what that means is that every time your client invests, a British Business Bank money or government money will go in alongside the client. They really like that for that institutional validation, the kind of confidence in our investment decisions. From our perspective, especially in SEIS, where we're restricted to 250k per company, that's a government legislative rule, we can actually deploy more money. We can deploy more, like £330,000, because we have this additional British Business Bank money, which means we can be more competitive in a very, very competitive space. And cool to see that some of my peers in the market also offer fast deployment. We love fast deployment. We like to get your money working. We're working on around 2 to 3 months deployed. Talk to you a bit about the funds that are currently open and will be deploying in this tax year. And this is kind of cheeky of me to include, but I'm obviously going to include this really nice quote from Hardman Co from the last review, who referred to us as the best established S/EIS manager of its age. We're just doing another review now, and I'm a really big fan of these, really detailed accounts, so I'll be sharing that with everybody when it comes through. What we invest in is super broad. So business to business software companies, but actually it's more sort of tech generalists. I'm going to break this down for you. The reason that we like B2B is because we like recurring revenue, long-term contracts, the kind of companies that are earning money whilst they sleep. That is really helpful when it comes to exiting businesses, especially if you're going to sell them, if they're going to be acquired. And that's where investors make returns. We also lean towards software as a service, or you might hear people call it SaaS, because once the software is built, there is little incremental costs. If you think, I've got a software, I've built it, then I just need to download on everyone's laptop, maybe support them through using the software, but I don't have to, have offices or additional staff members across the globe. So it is a very scalable industry, which I think reflects some of the fast and high exit returns that we made last year. It's also really diverse. There is no industry that I can think of that doesn't rely on some sort of software. Nowadays, we're all using software right now, for example. So we've got about 40 plus sub-industries within our fund, really built for scale from day one. The thing that makes us different, and we're super picky on, is that the companies we invest in have to solve some kind of what we call a pain point. If you speak to Scott and Fred, they'll say the kind of pain that keeps a company up at night. So we're backing software or tools that companies become reliant on, that kind of really sticky software that'd be a nightmare to remove or replace, and saves you time, cost, or risk, or ideally all three. A great example of this is one of our companies that we exited this year, or last year, I need to start saying, now we're in 2026, is a company called Reflow. So they are a construction industry company. They exited for 6.5x in 4.5 years. So VCT beating timescales, really good returns, exactly where we want to be. But their software basically helped in the construction industry builders upload pictures of the progress from building a home. It's a lot more complex than this, but I'll just keep it simple for the story, for the good story to repeat to clients. But what the issue is in the building industry is that there's a massive kind of disconnect between the field guys and the office team. And this creates a lot of cost and also a lot of compliance and safety risks. This kind of software allowed office managers to keep the field guys accountable, but also it's reducing safety hazards because the software can immediately identify risks. So you can see that once that is implemented, how reliant these kind of companies will go. And obviously it just took off in a really short period of time. To tell you a little bit about the different funds we have, so we just have really simple 2 funds, our SEIS and EIS. They're both evergreen, they're both open all year round, but we'll deploy these in tranches. So if you just speak to us, we'll tell you what's open at the time, and we'll tell you when it's due to close and when roughly it's due to deploy. Our current SEIS fund, so this is early stage, as Brian mentioned earlier, although we do as a company lean towards businesses with some reoccurring revenue at this point. But this is our current raise is open for deployment in the next tax year. The thing with our EIS is that we have a 4 million hard cap, and this is designed to preserve the quality. There's a much wider pool of companies available at SEIS stage, and we're more restricted to what we can invest, obviously the 250 cap. So at the moment, we have 3 tranches a year, 9 to 15 companies, but the last 4 tranches, we have reached the 4 million cap around up to a month early. So assume that it will be 15 companies within that tranche if you would like to invest or recommend. If you are thinking about investing in the current tranche, although its deadline is April, we've already raised about 20% of this tranche, so we're expecting it to shut in about March. So if you would like to reserve allocation, please let me know ASAP, and I will arrange that for you. Our EIS is later stage, so we say it's an absolute minimum that these companies should be raising K annual recurring revenue. In reality, it's much higher. So our last tranche, it was average about £1 million annual recurring revenue across the companies. And it's made up of our top performing SEIS companies and new EIS opportunities. But those new ones are co-investing with really world-class tier 1 investors, the global names like the ones that you can see on your screen. EIS is uncapped because the companies at this stage can responsibly absorb more capital as they scale there later. And we typically invest in around 4 to 6 companies, progressing towards Series A or B. And the idea is that we're either doubling down on our current companies or attracting world-class capital in companies with an already strong record and a clear route to exit. So our current EIS tranche is open for investment for deployment in this tax year. We'll be shutting it right at the end of March, and we'll be deploying it before the 6th of April, I think it is this year. So that will be a fun week in the office that I will avoid like the plague. Some examples on the screen of some unrealized returns. So we strip out our return figures down to the kind of bones. We don't put any tax release in there. And these are all based on formal funding rounds, not independent valuation. So it's the market standard. You can see some really nice numbers. Obviously, if you're looking from the left to the right of the screen, starting in 2019, the numbers are going to be higher there because we've had more time invested. So those companies have had more time to grow. But some great examples, even in 2024, Beings, for example, Augmented, we only just invested in them at the end of 2024. So it's just been over a year already seeing really nice growth on those multiples. Here are the 2 kind of biggest exits that we had last year. So we had SEIS exit in a company called Native Teams. Would love this example because it's quite a simple problem that they just identify by experiencing it themselves in their own companies, created a software to solve it, and scaled and sold it 0.4x in 3 years and 2 weeks. So this was a company who basically identified that it's an absolute pain for people hiring remote workers that live in different countries to pay them to do it all compliantly, and their software solves this entire problem, and it just took off in such a short period of time. The reason that we deliberately held it for 3 years and 2 weeks is because you have to hold it for 3 years to claim your tax release back. So all of those investors got 7.4x on their return and all the tax release that they used going into the SEIS. So it's actually probably more like 12.8x if you include just the income tax relief there. And Reflow, we've talked about, a great example how we've invested in a company twice because we saw it had a clear route to exit. We saw the possibility of it for our investors. So those second round of investors still got really good returns, 4x in 3 years. But the first ones with the flex got the significant returns. Obviously, I'm talking to you a lot about the good and the amazing things at Haatch and all the companies, but we like to be super transparent. We are in the world of venture, and if we don't have losses, if we don't have failures, then we are probably not taking enough risk. So some examples of failures on the screen here, various reasons. Every time we have a company failure, and we class it as a failure internally, even if it exits at a partial loss, we have a big company meeting. We go into the detail of how we could have prevented it, if any, or how we can avoid these in the future. I think some of these are because our thesis has changed. We previously invested in B2C. That's not our area. That's not where we see significant growth. It's allowed us to refine our thesis and really focus it in this space, which is delivering. And this is where we're expert in. So out of 174, when I last checked, investments, we've got 10 failures so far, and that number will keep growing. If you're going to invest in SEIS, 15 companies, we do not expect all 15 to do 7.4x. But it just takes one big one, for example, that Native Teens exit, and that's a fund returner. So for those investors, which I personally had the opportunity to ring some advisors and tell them the good news, they returned the entire fund in just one exit. So a really nice story to pass on. We don't have any hidden fees. We charge an upfront fee of 5% and an ongoing of 1% for 5 years. It's kind of a bit optics there. It's essentially the equivalent of 10% upfront. That seems really high, but GrowthInvest actually did some amazing research for us. And we're coming out in one of the cheapest in the market. We really do not want to charge our investee companies anything. We find that we're very competitive, and also because we're investing alongside tier one investors who do not charge anything to these companies, it's really important. So we have that just solid initial. We don't have any hidden fees, dealing fees, additional admin charges until we've returned 100% of the capital. So that's without the fee included. So if you invested 10 grand, we won't charge anything until the full 10 grand is returned across the portfolio. And then after that, we will charge 25% if we return over 1x and 30% over 5x. We're all motivated as a business to return those X. We all bonused on that amount. So hopefully that's nice, short and sweet. This is the team. Please feel free to contact me. We're all really contactable at Haatch. Our emails is nice, simple. I'm Olivia at Haatch with 2 A's. Or someone said it's like how Jeremy Clarkson would pronounce Haatch to me the other day. Haatch. So I'd love to hear from you. Thanks, Brian.
Okay. Well, thanks, Olivia. I think we're we're pushing for time a little bit, so we're going to move straight on to our next presenter. I don't think we've really got time for questions, unfortunately. But thank you very much. If we can pop up the poll quickly. Thank you very much. So yeah, so as Olivia said, she mentioned exits, and I know we're going to talk a little bit about exits later on, but I think it's really good that we had a couple of fallow years for exits in the venture capital market. I think in sort of 22, 23, 24 sort of exits were a bit thin on the ground, but the last sort of year, 18 months, we've definitely seen a pickup again. And it's, I think it's making everyone feel a bit better about things when we start seeing some exits come back to the market. So I think congratulations to Haatch on getting a few. Tim is ready, I see. We can get rid of the poll. I will introduce. So our next guest is Tim Wynne-Jones, who is from Blackfinch Ventures, who invest in tech-enabled businesses around the UK. So I shall pass you over to Tim.
Hello, I'm Tim Wynne-Jones. It's good to be here today. Thank you very much for having us. I am the head of new product development and investor relations for Blackfinch Group. So I'll start with a bit of a general overview of Blackfinch and who we are. We're a multi-asset investment manager based in Gloucestershire. We're a team of more than 150 people spread across the UK, and we manage over 900 million of assets now. We raise capital from a combination of retail investors and financial advisors. And we deploy that capital across a range of tax efficient investment products across private markets, as well as providing listed investment portfolios for a number of our advisors. Our solutions span our Adapt IHT service, which invests primarily in real assets across energy, property and forestry, through to our AIM portfolios, asset management, and a corporate management service. So we are truly multi-asset, and this provides a mixture of capital preservation, growth and income solutions for our clients. But obviously of specific relevance today is Blackfinch Ventures. So established in 2019, our ventures team has invested over £120 million into a portfolio of over 40 companies, and that is through our venture capital trust and enterprise investment scheme portfolios. Having both EIS and VCT products is obviously a real benefit because it allows Blackfinch to invest through the early stage life cycle of businesses. And in many cases, we co-invest between the two. Typically, the EIS invests in earlier stage opportunities where we identify technology businesses on the cusp of their scale-up journey. We source all of our investment opportunities ourselves through research and direct outreach. We see well over 1,000 companies a year. And then we typically filter those companies, we meet them, and we also do very in-depth pitches with those companies, typically 3 hours or so, which sounds like a very long time, but it's a very tried and tested process for really understanding what these companies are pitching, and also crucially going beyond the sort of high level, very slick investor presentations as they usually are, to really understand some more granular detail around everything from go to market, the financial model, the technical assumptions, what kind of support they have, etc. So we also co-invest with many other venture capital providers, and we typically look for early stage businesses at seed to Series A, where we invest typically anywhere from £500,000 to £3 million. We focus particularly on technologies solving real needs in deep markets, and particularly with businesses that have long-term recurring revenues and low churn. Really importantly, though, we focus on talented founders and teams who can show that they have the expertise to adapt, evolve and thrive, which are our company values, because the startup and scale-up journey is always challenging. There is always going to be the need to adapt and pivot the model. And so really we're focusing as much on the team as we are on the product. There has to be product market fit. There has to be a really clear growth trajectory, and it has to be a deep market. But I can't emphasize enough how much we focus on the founding teams and their experience and their ability to scale. On this slide just shows diversification. This is incredibly important to our advisors and their clients, and our portfolio really reflects this. So this is just our EIS portfolio. It doesn't incorporate our VCT investments, but we carefully spread our investments across sectors, industries, technologies, and stage of company. So it's always a very carefully put together piece. That said, we also look to attract the strongest companies across 3 major growth themes that also align to our group-wide expertise. These are the energy transition. So we leverage the experience of our energy and property teams. Deep tech, we have 3 PhDs on our team. So we have very strong links into universities and incubators. And we spend a lot of time nurturing those relationships, both to source opportunities and also external expertise and advice on both opportunities that we see in our pipeline and also in helping our portfolio companies scale. And fintech, we're quite unusual for an investment manager in that we have our own CTO from the pensions industry. We have our own dev team, and we have our own intra-company startup that we launched focused on pensions called Thrive. So we really do lean into our group expertise in these particular areas. You will recognize there one of the examples that was in Declan's presentation. So we are a co-investor with OnePlanetCapital in GT Wings, which is the wind propulsion technology for commercial shipping, which we fully support as a fantastic business, and has really showed great progress with 10 transatlantic crossings now of their first product, and they're already iterating their next product and working with some major global shipping companies. In deep tech, again, another one that Declan referenced, Telpy, and also Neuranics, which is another great business. And in the fintech space, Currency, which is a fantastic business that is effectively a layer on top of your current account that allows you to spend abroad without incurring all of the foreign exchange transaction fees and banking fees. So it is as if you are paying directly from your UK-based bank account, which saves a lot of money for a lot of people when traveling abroad. Our point of difference really is our team. So we have a combination of investment specialists, exited founders, and key team members with direct operational experience in the sectors in which we invest. We make that a key point of our recruitment. And so these are people that have been there, understand the industries that we invest in, have faced the challenges, warts and all, of growing businesses in that space. So it's very, very important for us. And that's also supported by a venture partner network of industry experts who we typically appoint as advisors or non-executive directors to the boards of the companies that we invest in. So we typically have a board observer from the Blackfinch team, and then also the external industry expert. Again, it's very important to us that we do have that objective, impartial and unbiased advice. But also, again, these are people who have been there, done it, and it's really important that they are in these board meetings and really helping steer these companies and give them the advice and connections that they need to grow. So fees and details are available on our website and in all of our literature, but just to cover this briefly, our minimum investment is £10,000. We target a return of 3x. The investment objective is growth. We have a 3% upfront portfolio establishment fee and then a 2% per annum annual management fee capped at 4 years. Our performance fee only comes into effect when we have achieved 130% hurdle rate. And that's a 20% performance fee at that point. We have a target exit period of 4 to 7 years. And then the exit routes, which should be understood by most on the call, are either through a trade sale. So we do see a number of corporates and others looking at strategic M&A, or initial public offerings, so going public via IPO. An important one, we do deploy in up to 12 months, but we do have the option for full deployment within the current tax year. So that's very important, obviously, to achieve the tax benefits that many of our advisors and their clients are seeking. So we do pride ourselves on that. We are very mobile and nimble. We've really sort of evolved beyond tranche-based investing. We are looking at investments all year round, and we invest into a minimum of 10 companies per investor, unless they wish to have direct exposure to particular underlying opportunities. But the important thing is that even if we receive applications in mid-March, we can guarantee full deployment by the 5th of April to be within tax year. So just to summarize, the reasons that Blackfinch are well placed in this market. Firstly, the attractive tax benefits that apply across the EIS space, but also we do build very diverse portfolios with a minimum of 10 companies, and the fact that we can combine with many other investment vehicles such as the VCT or IHT means that we can build investment portfolios based on client needs around whether it's capital preservation, income, or growth. We can invest quickly and accept applications up to mid-March, supporting growth companies with providing tax wrappers and also providing that access to alternative asset classes, and with a particular focus on finding, identifying, curating, growing really high growth opportunities within the UK. So that is it from me. Thank you very much.
Thanks, Tim. I jumped in a little bit early there because you did a long pause and you caught me out. Thanks very much. Very informative again. You mentioned there the overlap where you've done a co-investment with OnePlanetCapital, and we know that happens quite a lot in the space. Given a lot of the managers invest in similar companies and sectors, etc., what's a differentiator for people looking at Blackfinch, I guess, versus other managers? And obviously not to put OnePlanetCapital down because you're both working together as well. But what's the key differentiator?
I think the importance is that we're quite flexible and adaptable. So we typically lead rounds and have historically led rounds, but that's not always the case. There are other investments within our portfolio. For example, we are invested in a business called Supercritical, which is a electrolysis manufacturer for the production of green hydrogen, and they particularly focus on the production of ammonia, for example. So this isn't hydrogen for home heating or transport, where we think that's a lot further out. There's a huge existing demand for hydrogen in industrial processes, particularly that manufacture of ammonia that covers cleaning products and everything else where ammonia is an essential component. In that round, we co-invested with Toyota Ventures and Shell Ventures. So we were a much smaller investor in the round. But the fact that we're adaptable enough to work with Toyota Ventures, Shell Ventures, the very large investors, and the likes of OnePlanet at the smaller scale, who we really value working with, we've got a great network, which means it helps with us sourcing the really good deals. Because firstly, we place a lot of stock on our network and working with the right co-investors. So we take deals to them, they bring deals to us. But also, it is a very competitive landscape. There are a lot of venture capital providers out there. We look to really attract the best companies, and we do that, as I mentioned, through our internal expertise, but also because of the caliber of the co-investors that we work with. So it's, you've got to be able to present to investors that full picture.
And then I guess you mentioned there about the pipeline, the companies coming through. How do you source those companies? What's the key, source for you guys?
It's a real mixture, to be honest. A lot of it is the word of mouth now. We've built a very good reputation as a very good manager to work with, and we've added a lot of value to the companies that we work with. So a lot of our portfolio companies do recommend us to others, and founders tend to be quite, they're very well networked with other founders, whether they've come through incubators or things like that. So word of mouth is a big one. We also, we do a lot of research in-house. We have proprietary tools that help us to identify companies before they actually go out to raise. So we've trained an AI tool that effectively shows all of the key characteristics of when a company's going to raise. So we contact them via outreach to say, are you in a position to be raising? And quite often they say, oh, that's funny, we've just been talking about it. And that's no coincidence. That helps us get in early with the really good companies. And that's really important to really kind of build a rapport that way. And then also just through networking and events, we have a number of companies approach us, even through our website. So it is multi-channel, but really the largest one is our own proactive outreach, because we don't just want to be looking at any company that approaches us. We want to go out and find the best ones.
Perfect. That's the questions for me. Brian, I can hand it back over.
So we had reviews of both Blackfinch, EIS, and VCT that came out at the back end of last year. So update reviews, those are available for free on our website. As Olivia mentioned, we're currently in the process of updating the Haatch reviews as well. And hopefully those will be available sometime in the next sort of month or 6 weeks. So that's kind of what we're aiming for. So look at those. Those are free to access. So if you just go to the website, you can download there, or I'm sure the managers will be happy to send them to you. We're going to ask all the presenters to return because we got 10 minutes and I know we have some group questions.
Perfect. Okay, ready to go. So these are more general questions. And Olivia, I apologize, you didn't get a chance to hear any of my questions earlier. So I'm going to target this one at you first, but everyone else, please jump in as well. Very topical for Haatch, obviously 2025. So saying easy to invest into EIS, or fairly easy to invest into, but harder to exit. What's the outlook for exits going forward?
Well, that's a good question. Well, it depends on investment manager and thesis, and everybody will have like different time horizons as well. So that's important to consider. Obviously, I think everybody on this call is really exit motive. When you go in, I think a lot of advisors will say, like, clients will go in for tax purposes. And I talk about tax release and sales planning angles all day. But when I speak internally, they don't have a clue about those. They're just completely thinking about exits. So yeah, I am really positive. There'll be a lot of more opportunity in the future now that I think a couple of legislative changes have happened last year with making these funds kind of more generous and things like that. So it's definitely a good time to invest. Hopefully that answers your question.
Yeah, anyone else want to jump in on that?
Difficult to predict exits. We have had some funds, some companies where we've had some secondaries where other investors have moved in and we've judged that the rapid growth period taken place. I mentioned Refine in our business. Some of our investors chose to take money out from Refine at the latest round. And even one of the companies that in the end failed, some investors got a 7x return, not taking tax breaks into account, on a company that then later went down. So there were those options. But otherwise, it's about, in our kind of things, it's getting the company to the point where it's ready to, where it can be ready when the market is ready to purchase. It's not always that you can go out and push for a sale. You do have to wait for the timing, especially if you want a decent return.
Perfect. Anyone else want to chip in or move on to the next one? No, move on. Brian, I think you may want to jump in on this one as well, because you wrote the paper a few years ago on allocations into venture capital and where that should sit in a portfolio. But a specific question we got in was, what proportion of available budget for high risk investments should be split across VCT versus EIS? Now, whether we want to compare VCT and EIS on this one, or we want to focus on the EIS side, but happy for anyone to jump in terms of conversations you have with advisors and what they think about when they talk to their clients, and what you guys talk to the advisors regarding this, the allocation. Who wants to jump in first? Go on, Andrea.
One of the issues is advisors have told us that their software considers anything other than a bond as a 6 out of 7 on the risk. It kind of narrows us into a small bit at the far end. I think what happens is as available money goes up, the portion increases. We've had a number of very good investors over the years who've made lots of money, sometimes by investing in earlier iterations of Oxford technology, and have come back and say, well, I've got plenty of money to live on, so might as well put it into growth and making things happen and enjoying the occasional very large return. There, the percentages are much higher than you would get with a more normal, and I mean that statistically, investor than the high end.
Yeah. And I think it's worth saying that they're both in the same risk category. I think they work really well together. I'm actually doing a presentation next week on how VCT and EIS really complement each other. So if you think your VCT lasts, 5 years, at the 5-year point, if you were into investing in EIS and a VCT together on day one, in 5 years, obviously you can hopefully sell your VCT at a reduction of the NAV. And then that's potentially when you're going to start seeing EIS exits come through, which are tax-free. So I think it can be, they're just different, they're structured different. It's actually a great idea to diversify across both of them, just to be conscious that obviously VCT income tax relief is going to reduce from April. Last time when it reduced, it did really impact fundraising. VCT's health of the health of the VCT is reliant on how much they can fundraise. So something to consider, I think.
And I would just add as well that I think when it comes to allocations, there definitely isn't a one size fits all. And obviously, we're not in a position where we offer financial advice, but we do consider that you need to carefully think about the client's objective. Again, if they have an income objective, then the VCT is probably going to be more suitable when VCTs are dividend paying. So we pay a biannual dividend, whereas that's not the case within EIS. But if the client doesn't have that need for income and doesn't have the liquidity requirement, but is really looking at growth as their primary objective, then the EIS may be more suitable. So it's just important that anyone really thinks through primarily why are they looking to make this investment. More often than not, it is the tax relief, but also it may be equally because they have a high conviction in a certain sector or subsector, and therefore they want to look at opportunities in that space and are willing to take a high risk investment position in order to do that.
Yeah, I mean, I would just echo Tim's point there that the investment outcome of the client is really, really important to consider. A big bugbear for me, I'm sure, of the panel is that VCT sort of automatically get assumed to be lower risk, although under the bonnet of both of these vehicles, the companies are doing similar things. VCT might be a little bit later stage, but not all of the time. So, the companies and what the companies are doing are very similar, but VCTs are not always guaranteed lower risk.
I might follow on from pick up one of Tim's points. That it's definitely horses for courses here. I think, as Declan just said, the underlying rules of what companies can invest in are the same. But in practice, VCTs, I think the average VCT is probably a little bit later. So I think the way Blackfinch, for example, looking is that the VCT might typically follow on to what EIS companies done. Consequently, there's a slightly lower growth profile. The investment characteristics are slightly different. In VCTs, they carry cash. There's good reasons why I need that for follow investments or funding dividends, but that can cause friction on returns because you're paying VCT charges on a level of cash. And if you do diligence with cash, some of the VCTs carry a bit too much cash, I think. Having said that, on VCTs, you have that 5-year rule where you can get liquidity, you get the tax-free dividends. They may be important for some people. I think EIS is up 10 year. EIS funds are really a 10-year investment, at least. So weigh which of those matters for you and give a priority. I think, you can make a case for, many investors to invest across both. New investors might want to get a VCT initially to get VCTs get diversification, and then EIS to sort of maybe pick something more specialist. That's one strategy.
There is, of course, the point that the VCTs, you don't have loss relief on your losers. It just comes out of your returns and they don't come back. And that's really where the SEIS and EIS, if you factor in the tax, and providing you have income tax that you're going to be paying over the years when you would get the returns or the losses, then that really contributes to the overall return of the fund, reduces the risk of ending up with less. But VCTs play a useful role, essentially.
Yeah, very true on that. And one of the things they don't offer is inheritance tax relief. And that came up earlier from Brian and in a couple of presentations also. Conversations you guys are having with advisors, is EIS, SEIS coming up as a solution for IHT? Is it part of that discussion now?
I'll jump in on this. Yes, in a word, the pension changes, namely, are causing a lot of advisors that in previous years, so that the EIS isn't something that they would consider. They are now having to look at other vehicles, of which EIS is one. But not just that. I mean, the pension changes is a big one, but changes on capital gains as well in the limits and that kind of thing. So yeah, EIS, I would say generally across the board, is being looked at and utilised much more as a tax planning vehicle than it has in a long time, I would say.
Yeah, us too. I think what we're seeing is actually quite big chunks coming out of pensions. So if you had a pension that you were previously just basically assigned for your beneficiary, obviously now you're thinking, oh God, I would maybe potentially soon pay IHT on that. When you extract the money, obviously you pay tax, but then you use the EIS or SEIS income tax to offset the tax that you pay. So it can work really well. And then it's free from IHT after the 2-year holding period. So I think probably become one of from my least popular planning angles to my most, weirdly, this year.
Yeah, I would say for any advisors that don't like EIS, it really should be a tool in your toolbox that, it's not for every client. It's not, potentially for the whole solution, but as a part of a solution, it's really something that should be considered.
Yeah, very good way to finish on that. Brian, I'm conscious that we're through 2:00, so I'm going to hand back over to yourself.
Okay, yes. As Steve said, we've now hit 2:00. So we're going to draw things to a close. So thank you everybody for coming on and listening. I hope you found it enjoyable and interesting. Big thanks to Andrea, Lucius, Declan, Olivia, and Tim for their interesting presentations. This is the last one, I think, for this tax year. There'll be more in the autumn. If you want to find out more about these things, all our guests at various points have appeared on our podcast, or they'll be delighted to speak to you if you want to get in touch. There is recordings going to be available. So if you want to catch something, if you had to go to the toilet or anything, the recording will be available later on, or if you want to pass these on to a colleague. This is also eligible for CPD. So if you want to qualify for CPD, let that in. You'll see that a poll has already popped up. So please complete that before you go. Thank you very much, everybody. And we look forward to seeing you again sometime in the near future.